Did you know that dividends alone can pay for your retirement if planned correctly? But what exactly are dividends? In this video, we'll explore how dividends work, the different types, and how you can use them to grow wealth or even retire comfortably. Dividends are payments made to shareholders from a company's revenue, representing a portion of its profits. For example, if Coca-Cola's net income for a year was 500 million, and the company has 500 million shares, they might reinvest 300 million back into the business for growth. The remaining 200 million would be paid out as dividends, split evenly among shareholders. If you own shares in the company, you essentially share in its profits. The amount you receive depends on how many shares you own. There are two primary types of dividend-paying stocks: preferred stock and common stock. Preferred stock acts more like a bond. It combines elements of equity and fixed income securities. For instance, if you purchase preferred shares of a company at a par value of $100, with a 5% annual dividend, you'd receive $5 per share annually. While preferred stocks often provide consistent payouts and have priority over common stock in liquidation, they generally do not mature like bonds, and the initial investment is not repaid unless the shares are redeemed by the company. It's similar to a loan, where you lend money to the company in exchange for consistent payouts. Common stock differs and is primarily viewed as capital growth investment, in addition to potential stock price appreciation. You may also receive dividends, but these are not guaranteed and depend on the company's performance and decisions made by the board of directors. Dividends for common stocks are usually paid quarterly, but can also be semi-annually or annual. So which companies pay dividends? Among the top 500 US companies, many pay dividends. Established companies like Coca-Cola, which have reached their growth potential, often distribute dividends as they no longer need to reinvest all their profits. On the other hand, growth companies such as Amazon typically reinvest their earnings to expand their operations instead of paying dividends. Coca-Cola is a well-known dividend-paying company because it has reached a point where reinvesting profits yields diminishing returns. Amazon, despite being a global giant, reinvests heavily into new ventures like AWS and real estate, prioritizing growth over payouts to shareholders. Dividends are paid out based on decisions made by the company's board of directors. Each quarter, they meet to determine how much of the company's profits will be distributed to shareholders. For example, if the board of directors decides to pay $1 per share and you own 100 shares of PayPal, you will receive $100 in dividends, regardless of the stock's market price. Dividends can be paid in three ways. Cash dividends. These are deposited directly into your brokerage account as cash. Reinvested dividends. These allow you to automatically use your dividends to buy more shares, often at a discounted rate. Product dividends. Though rare, some companies offer physical products instead of cash. For instance, a smaller company might distribute its products to shareholders as dividends, but this approach is uncommon for larger corporations. The average dividend yield for the top US companies typically ranges between 2% and 4% annually. For example, SCHD, an ETF focused on high dividend-paying stocks, offers an average dividend yield of around 3.5%. VU, which tracks the S&P 500, offers a lower yield but combines it with potential capital appreciation. Dividends provide a consistent return without requiring you to sell your shares. Over time, reinvesting dividends can significantly grow your equity in a company. Companies pay dividends to reward shareholders and attract long-term investors. It's also a sign of financial stability, as consistent dividend payouts suggest a company has strong cash flow and profits to share. Qualified dividends are taxed at a lower rate compared to ordinary income, making them more tax efficient. For example, while ordinary income might be taxed at a rate of up to 37%, qualified dividends are taxed at capital gains rate, which range from 0% to 20% depending on your income. Dividends are an excellent retirement strategy due to their consistency and tax benefits. For instance, if you need $50,000 annually to retire, you'd require a portfolio of about 1.25 million invested in dividend-paying stocks with an average yield of 4%. This allows you to live off dividends without selling your shares, preserving your equity. Spirit Airlines is a prime example of the risk tied to dividends. Before its 2024 bankruptcy, the company offered dividends to attract investors, despite facing growing financial issues. At its peak, Spirit Airlines' market capitalization declined from over $6 billion to nearly zero. With debt exceeding $29 billion, the airline struggled to balance operational costs and investor payouts. By prioritizing dividends over reinvestment, the company's valuation and stability crumbled. Eventually, bankruptcy wiped out shareholders, making their investments worthless. Always research, because dividends can be a red flag when a company lacks strong financial health. Dividends can be a powerful tool for building wealth and generating passive income. Whether you reinvest dividends for growth or use them to cover living expenses, understanding how they can work can help you achieve your financial goals.